Hi, I'm Keith McCullough. Welcome back. We're going to get into the final theme of our Q3 macro themes here at Hedgeye Risk Management, which is called Asian Contagion. Asian Contagion. What are you thinking about when I say that? At the end of the day, what I'm thinking about is longs versus shorts, okay? What I like and what I don't like. So to be clear, there's always something to like and something not to like in markets, particularly in Asia. So what you see here in this chart, just to get to the heart of the matter, is Asia ex Japan. Ex Japan, Asian equities don't look good. That's a pretty straightforward concept. And again, the reason why they call it ex Japan is because for a long period of time, you would actually want to own anything other than Japan. So we want to flip that idea on its head. At Hedgeye, we're constantly looking for these big mean reversion trades that people haven't been in for a long period of time, and this is one of them. We want to be long Japan, and we want to be out of other Asian equity markets on a relative basis. Now, let's look at Japan a little bit more closely. Now, this is a fairly squirrely situation, of course, because these people are going to engage in the same policy that they learned from Americans. Now, again, Americans being Obama, Bernanke, and Geithner. So, in other words, burn your currency and fiscally spend. That's basically what they're going to do. And while that's really unfortunate because it doesn't really give people what they really need or want, which is confidence and a high level of real inflation-adjusted growth, what you get is monetary math. So what you see here in this chart is what the Japanese are actually going to do, which is try to get to 2% inflation. And they may very well get that by burning their currency. But again, just to invest in that, I want to short their currency. And that's pretty much the simplest thing that you can do. So let's look at that currency. Japan versus the USA going back to 1983. Now, you'll recall the 1980s or 1990s were very good times in this country from a protecting of your currency's perspective. Now, again, Bush and Obama, this was the travesty that is both Ben Bernanke being part of their lives, which is that he went with the debt monetization, money printing, and currency devaluation thing, which really didn't work. But again, the other opportunity here is to just short the yen because, of course, the yen made a 40-year high in the third quarter of 2011 versus the dollar, as the dollar, of course, was making that low. So I think this one to 135 is pretty straightforward. What's less straightforward is buying Japanese equities. I mean, the reality is that it's tough to swallow when you're doing something that you fundamentally don't believe will turn out to be good in the end. Well, that's not how you trade a market. How you trade a market is looking at precisely what I just said. If the most recent pattern of behavior is that the currency goes down in Japan and people buy equities with that, then just do that. 16,400 in the Nikkei is our first long-term mean reversion level of resistance. So there's a lot of upside in Japanese equities, by the way. It's a deep liquid market, and it's actually not that expensive at all. Now, going back to the issues, there's a lot of issues, a lot of baggage when you talk about this Asian contagion stuff. I mean, again, what do you think about when I say that? That's the kind of stuff that can really go a little gnarly on you. Now, what could really go gnarly is an investment when growth starts to slow. So if people pay a high multiple for high growth, which you can see here, in 2010, really when Chinese growth was running double digits, people were paying big multiples for Asian equity markets. But they'll pay less multiples as growth goes this way. You get multiple expansion as growth goes that way. In other words, growth goes up, multiple expansion, growth goes down, which we think will happen in Asian growth for quite some time here. You're not going to pay a big multiple for that, or at least I wouldn't. Now, thinking about this in terms of the broader exposure, think of Asia in terms of what they're really addicted to, which is foreign direct investment growth. So again, this level, we're kind of at the top side of where it could go, around a third of their total GDP. Now, this isn't like the US, so they're not completely in the same picture that we are here. If we had this problem, it wouldn't be as much of a problem. But these are their issues. Capital chases growth. So when growth slows, which we believe will continue to happen in Asia, you're going to see people flow less capital to these markets. Another of the many reasons why you want to be in U.S. equities is the funds are flowing out of Asia into the U.S. on that basis. Now, overvalued currencies. This one's very straightforward. This is like an easy one, I think, and not a lot of trades are easy. But again, the 10-year mean here, we were 2 standard deviations overbought. That could easily correct back to the mean. And I don't think that there's any real bull case for Asian equities, provided that the dollar continues to go higher here in the face of it. Now, just to tie a ribbon around the whole thing in terms of how our model works, look at inflation. Inflation in Asia, while currencies were strong, was low. Now, currencies are coming down, and guess what? Inflation's going up. A case study in this is India. India's seen its currency drop double digits year to date. The rupee's down about 12%. Now, in the face of that, what do the Asians get? Or at least the Indians are getting, and Asians are starting to get this more broadly as well. This line is starting to hook up. Inflation is rising because the currency value is falling. Now that's just a travesty for the people. And again, that's not something that I'm going to be able to solve from society's perspective here today. But what I can tell you is don't buy those Asian equities, and definitely don't buy something like an Indian equity market index that looks cheap, because cheap is going to get cheaper if growth falls and inflation rises. All right, to summarize, the theme is Asian contagion. It's a very simple theme, and there's bullish and bearish things to do. The number one thing you want to do is short the Japanese yen. The number two thing you want to do is buy Japanese equities. And the third thing, which I really want you to do, is get out of the way on these Asian currencies. They are highly suspect in a rising rate and strong dollar environment. That's our macro theme. If you have any questions, my name's Keith McCullough. My handle is the same, @Keith McCullough. And of course, you can find us @Hedgeye TV on Twitter as well. We'd love to hear from you.